day friends. In the subject of personal financial planning, we are discussing on investment management or investment planning. In the subject of investment planning, in the lectures on investment planning, the risk and return concept is very, very important. In my previous lecture, I talked about what is return, what is risk, and we talked about two types of risk. One is called systematic risk, other is called unsystematic risk. Systematic risk is that risk which is basically non-diversifiable. This is because of macro factors which impacts all companies, which impacts all business houses. On the other hand, the unsystematic risk is company specific, corporate house specific, which is subject to diversification. If you hold different securities in your portfolio, then you can diversify your risk. This is being shown with the help of this chart and the graph, that number of stocks in the portfolio. On the x-axis you are showing number of stocks in the portfolio, and on the y-axis you are showing portfolio risk. This dotted horizontal line, first we have made this horizontal line which is showing basically systematic risk. What you are noticing here is that systematic risk is same, means it doesn't changes with a change in the number of stocks in your portfolio, whether you hold one share or whether you hold 2 shares or whether you hold 20 shares. As far as the systematic risk is concerned, it will remain same because it is basically undiversifiable in nature. On the other hand, the other is called unsystematic risk, which is company specific. As the number of stocks increases in your portfolio, if you are a good investor, if you are a prudent investor, if your financial planning is good, what you do is that you purchase your investments, you make your investments in different industries, in different companies, so that your risk is diversified. If there is some problem in the management of one company, it is not necessary that there will be management problem in the other company. If one company's CEO exit and the all top board of directors leave the company, it is not necessary that the other company's board will also be impacted by it, right? As we are aware that if CEO of the company who has a good standing in the company, if he or she leaves the organization, it makes an impact on the share prices. If the important executives of the company leave the company, it makes an impact because CEOs and the top leadership is a think tank of the company. It makes an impact on the progress of the company, right? So if it happens in one company, it is not necessary that the other companies will be affected, right? The simple point I am making is that as far as the unsystematic risk is concerned, it can be diversified by holding different shares in your portfolio. So as you are finding here that as far as the unsystematic risk and systematic risk combined together, as you increase the number of equity shares in your portfolio, right, your total risk keeps on falling. It will not be below the systematic risk, but as you are seeing that it starts from the total risk, systematic plus unsystematic. As you increase the number of shares, it keeps on falling. But it doesn't mean that it will touch zero. What you can see here is in this graph that it is basically in this chart you are seeing that is falling, but it will not come below the systematic risk. So as you increase the number of shares, the unsystematic or systematic put together, the total risk will fall. So this you can show that what you can do is, since systematic risk cannot be diversified, but by prudent diversification we can reduce the amount of risk by holding the different equity shares. When I talk of by holding a large number of shares, it doesn't mean beyond a limit. Ideally, if you ask any mutual fund manager, any good prudent manager, means the ideal size of the number of equity shares which you hold in a portfolio may be 20 or 25, right? It is not being suggested that very high number of equity shares should be there in your portfolio, or for that matter in your different asset class. Of if you are holding a portfolio of different asset class, you can combine the different asset in such a manner so that your risk is being minimized and your return is being maximized. So when we talk of systematic and unsystematic risk, which I have already explained, now let me find out the reasons what causes systematic risk, what causes unsystematic risk. Systematic risk is broadly being caused by market risk, interest rate risk, inflation risk, exchange rate risk. And unsystematic risk takes place because of business risk and financial risk. Let's discuss each one of them, that what is market risk, what is interest rate risk, and so on. What is market risk? When the value of investment declines due to some events which affects the whole financial market is known as the market risk. As I said, systematic risk impacts all companies. Similarly, degree may vary little bit, but basically when the market fluctuations takes place, it may be, say for example, because of geopolitical reason. If the war takes place between the two countries, and two countries, the warring countries, are the large nations which are having import and exports from different countries of the world, right? Certainly it is going to make an impact on the global market, global economic market. And when such scenario arises, the valuation of equity shares of different companies will be impacted. It is not necessary that all companies' share price will be impacted to the same extent. But by and large, when the market falls, when I use the word market means the overall stock prices falls, then it impacts all the companies, right? So this is known as market risk. Supposing the interest rate changes or any reason, social, political, economic reasons, the market falls or market rises, whatever may be the situation. So if basically when we talk of risk, we mean on the lower side. When the market falls and overall the market is falling, the Sensex is falling, Nifty is falling, certainly it is going to make an impact on all the shares. This is what we know as market risk. So decline in share prices due to market factors. Your company is doing reasonably well, but the market, the people in general are not willing to invest even in that company. So your company's share price will not fetch a very good price in the stock market. Such situation is called market risk. So decline in share prices due to market factors such as economic, social, political events, this is called the market risk. It constitutes 2/3 of the total systematic risk. Friends, this number is not the exact number. Broadly, when we generalize it, we say in a systematic risk, almost 2/3 of the systematic risk is because of the market risk. When market rises, the stock prices of all the different companies rises, right? Even those companies which are not doing very well, even those companies' share prices rises when the whole market is rising, right? And when the market falls, even the companies which are performing very well, even their share prices are also do falls, right? They may fall to a lesser extent as compared to the companies which are not performing as well, but still all companies' share prices gets impacted when the market falls. So this is known as market risk. Other is called interest rate risk. We are talking of systematic risk, and what are the reasons of the systematic risk? One is I talked about is the market risk, that when market falls, when I use the word market, it means the index, the Sensex, right, or the Nifty, or for that matter, if you're talking of any other asset class, you're talking of gold, you're talking of real estate, right? So as a whole, real estate market as a whole is falling, right? So the prices of all properties, howsoever the good value, good property may be, the price gets dented, price gets impacted of that property also, right? So this is basically market reasons. The other is interest rate risk. As the interest rates keeps on fluctuating, the variability in the return caused by change in the level of interest is called interest rate risk. Price of fixed income security has inverse relationship with the level of interest rate. That is, if the interest rate goes up, the existing price of the existing bonds, that is the current price of the bonds, will fall. That is, the interest rate and bond prices or fixed income security prices have inverse relationship. See why it's so. Supposing at present the market rate of interest is 6%, and the company has issued or Government of India has issued the 100 rupee bond on which the government of India has promised to give 6 rupees for a 10-year period. Rate of interest is being decided at the time of issuance of the bonds, right? Issuers of the fixed income securities. So your government of India, for that matter, RBI is issuing a bond of 100 rupees on which the government of India promises to pay 6% interest for 10 years. In the market, if the rate of interest increases, say from 6% to 8.5% or 9%, or say 8%, right? The same people who are investing 100 rupees on a bond, which fetches them 6% interest because that was the market rate of interest at that point of time, the same people will not be ready to invest 100 rupees on a bond which gives them 6% interest, because the real return which the investor wants is 8%, since the current rate of interest is 8%. So for purchasing the same bond, 100 rupee bond, the purchaser will be ready to pay less than 100 rupees, a price which is equivalent to yield, which gives him the yield of 8%, because the current rate of interest is 8%. So certainly that investor will give the valuation of the bond lesser than 100 rupees. So what you find is that as the rate of interest increases, the market price or the bond prices falls. That's why we say fixed income securities and interest rate has inverse relationship. Same thing happens if the rate of interest falls, right? Then the investor are ready to pay the same bond of 100 rupees a higher price, because they want is that what the investor expect. Investor expect the yield of the bond should be equivalent to the current market rate of interest, right? So this is called interest rate risk. Interest rate risk has two components: price risk and reinvestment risk. Price risk I have already explained, that as the share prices increases, as the rate of interest increases, the bond prices decreases. It means there is an inverse relationship between the rate of interest and the bond prices or the fixed income securities. So the risk associated with change in the price of the securities due to change in interest rate is called price risk. The value of the bond, value of the fixed income securities changes. The other is called reinvestment risk. When an investor reinvests the interest or dividend income at a lower interest rate, right? Supposing the rate of interest changes from 8% to 6%. Earlier the rate of interest was 8%, now the rate of interest is 6%. I am taking the other situation, not for increase, is falling. So I have invested say 1 crore rupees in fixed income securities, which are fetching me 8% return, that is 8 lakh rupees per annum. I am getting interest income of 8 lakh rupees, which I further reinvest. But if the rate of interest falls from 8% to 6%, so I will able to invest this 8 lakh rupees income, interest income which I am getting by purchasing that bonds on which I have invested 1 crore rupees, I will be able to reinvest this 8 lakh rupees only at 6% rate of interest. This is called reinvestment risk. Earlier when the rate of interest was 8%, I was able to reinvest my income at 8%. Now since the rate of interest has fallen from 8% to 6%, so the income that will be generated by investing in that bond, this interest income, I will be further reinvesting this interest income only at 6%, not at 8%. So this is called reinvestment risk. Means the income that is being generated by any investment, I will able to reinvest the return at a lesser rate of interest if the rate of interest falls. So what we find is that both these risks work in the opposite direction. If the price falls, the bond prices increases. But so it means when the rate of interest falls, certainly it will be beneficial for the current investor, those who have invested earlier in the bonds. But there will be more of reinvestment risk, right? So both these work in the opposite direction. The other type of systematic risk is called inflation risk. Inflation means when the price, inflation is association when there is a continuous price rise. And we say that normally there is a reasonable good amount of the price rise is called an inflationary situation, and when a continuous basis reasonably price increases, so that is called inflation. So inflation leads to the decrease in the purchasing power or the real income over the period of time when the investment return does not match with the increase in the rate of inflation, known as inflation risk. It is also referred to as purchasing power risk, right? So if inflation takes place, the real income, the principal amount that you will be getting after a period of time when you will sell off that asset, the purchasing price of that nominal income which you will be receiving. Nominal income is the nominal terms, the money which you will be getting, the purchasing power of that money will be less, right? Plus, every year the income if you are generating by the investment, the purchasing power of that return which you are getting on a regular basis, it will also decrease because of the inflation that is taking place. So real income is defined as nominal income adjusted for inflation. So you can say like this, real income is equal to nominal income divided by 1 plus inflation rate, right? So that is what the real income is. So what you are finding is, when there is a high inflation risk, it leads to the fixed income securities, for example, debt, bond, etc. No inflation risk is associated with equity shares, right? So this we have already explained. The other type of systematic risk is called exchange rate risk. Exchange rate risk is related to risk associated with the change in the value of the currency vis-a-vis the foreign currency. We call it exchange rate. The rate at which $1 is being exchanged with the rupee is called the exchange rate. Like most of the world do exchanges in terms of dollars. International business do takes place in dollar terms, although in the scenario is changing, but still by and large the world business takes place in terms of dollar. So at what rate $1 will be exchanged by that currency is called exchange rate. And when the value of this foreign exchange currency changes, it makes an impact on the import and exports of the country because of the change in the exchange rate. So fluctuations in the value of foreign currency is known as exchange risk. Companies dealing in foreign exchange transactions, imports or exports, are exposed to such risk. Means when a person is making a local sale, local purchase, all its raw material, all its inputs are being procured internally, right, and being produced internally within the country. So the rupee, all the exchanges will take place in rupee terms only, and whatever it sells in the India only. So the income that will be generated, that will be also in rupee terms. So that will not impact, that business will not be impacted by the exchange rate risk. But what about the businesses which are importing a large part of their raw material, or which are selling the large part of their production to the other countries of the world, right? So their income will be impacted by the change in the exchange rate. So companies dealing in foreign exchange transactions, import or exports, are exposed to such risk. Means the domestic players, both where inputs and output both is being done from within the country, they are not exposed to exchange rate risk. But the companies which either import the raw material or they export the manufactured goods, the produced goods, they are exposed to exchange rate risk. Suppose like if value of $1 rises from rupees 80 to 90, at present the rate is around 82, 83, right? 82, I would say. Supposing the value of dollar and rupee, that is $1 is equivalent to from 80 rupees to 90 rupees, then the company which is using imported raw material, right, for same purchase, the company will have to pay more in terms of rupees, right? So as far as the purchase price is concerned, if the deal is of 1 lakh or $1 million, the company will have to pay to the import to the exporter same $1 million. But since the value of rupee and dollar has changed in rupee terms, if it changes from 80 to 90, right, instead of $80 million, this Indian company will have to pay for the imports it made from the other countries $90 million. So it will have to pay more. This is what is known as exchange rate risk. That's why when the value of rupee falls, right, that is the value of dollar increases, certainly although companies which are importing raw material in dollar terms, they are being negatively impacted. On the other end, those companies which are exporting, means whatever they are producing, especially the service industry in India, whatever they are producing, they are exporting it. So those companies which are in the export business, right, they are getting their income in the foreign currency, they are being benefited by it, right. So like Indian IT companies, most of the Indian IT companies do business for Europe, for America. So the income which they get is in dollar terms. So if the value of dollar increases in Indian terms, they get more rupees. That is beneficial for them, right. So this is called exchange rate risk. Now after talking of systematic risk, let me talk of very quickly unsystematic risk. Broadly, I will say unsystematic risk in two categories. One is called operating risk, business risk, and other is called financial risk. Now, what is this business risk or operating risk? It is associated with investment decision of a company. The risk arises due to the presence of high fixed operating cost. What is high fixed operating cost? The manufacturing process is such that the fixed cost element in the business is very high. So it means the fixed operating cost is very high. As you increase the sales level, as the sales will increase, you will get the benefit of operating cost, because most of the cost is in fixed nature. The variable cost component, we are all students of commerce economics, we understand these things, right, that as the level of sales increases, the level of production increases, the fixed cost per unit decreases because fixed cost remaining same. So in those companies where the fixed operating cost is very high, as the sales level increases, the company gets profit at a higher rate, right. So this is called operating leverage. Because of the bad economic situation, because of any reasons, because of some micro reasons of your company, you are not able to produce much, you are not able to sell much. So it will lead to the unsystematic risk, it will lead to high operating costs. So this risk cannot be minimized. Only can be minimized by selling more. Other is called financial risk. Financial risk means how you have financed your business. Whether in your total balance sheet, the debt component is more or the equity component is more. So it is associated with the financing decision of a company. The risk arises due to presence of fixed financial cost like loans from the bank, loans from the financial institution, issuance of bonds to the public, right, on which the company is paying fixed rate of interest. Irrespective of the level of the business, the company will have to pay fixed interest, right. So this is called the fixed financial cost. So it is a measure of degree of financial leverage. Means the business risk is called operating leverage, the financial risk is called the financial leverage. If the firm does not use debt funds, there will be no risk at all because there is no fixed liability. So these are the two types of the risk associated with the unsystematic risk, that is business risk and financial risk. So in this lecture we have talked about the reasons of systematic risk and the reasons of unsystematic risk. Thank you very much.